What it costs if you ignore it. You could owe thousands in unexpected taxes. Plus, if you significantly underpay throughout the year, the IRS can charge underpayment penalties on top of the taxes you owe. Now here's mistake number 3, and this one is heartbreaking because it happens at the worst possible time. Mistake number 3, not adjusting. After a spouse dies, when a married couple is both receiving Social Security, they file jointly and have one set of income thresholds. But when one spouse passes away, everything changes. The surviving spouse loses one Social Security check. They also go from married filing jointly to single filing status. And here's the critical part most people miss. The income threshold for single filers is lower than for married filing jointly. For married filing jointly, up to 85% of your Social Security becomes taxable when your combined income exceeds $44,000. For single filers, that threshold drops to $34,000. So you lose income, but you also lose the benefit of the higher threshold. And most widows and widowers don't realize this until they file their taxes the following year. I worked with a gentleman named Richard whose wife passed away in March. She had been receiving about $600 a month in Social Security. Richard was receiving $2,400. Together, they also had a small pension of $200 a month. Their combined income was around $63,000 a year, and they were withholding 10% from both Social Security checks. When his wife died, Richard stopped receiving her Social Security check. His household income dropped significantly. He assumed his taxes would go down too, so he didn't change anything. But what Richard didn't realize was that he was now filing as a single person, which lowered his threshold for how much of his Social Security was taxable. Even though his income went down, the percentage of his Social Security subject to tax actually went up. The next April, Richard sat down with his tax preparer and learned he owed $1,900 to the IRS. He was shocked. He'd just lost his wife, his income had decreased, and somehow he owed more in taxes than he expected. Who this affects most? Any surviving spouse, but especially those whose combined household income was near the threshold amounts. The simple fix: if you lose your spouse, make reviewing your tax withholding a priority within the first 3 months. I know it's a difficult time and taxes are probably the last thing you want to think about, but this one action can save you from a nasty surprise the following year. Contact Social Security, request a new Form W-4V, and increase your withholding percentage to account for your new single filing status. What it costs if you ignore it. An unexpected tax bill during an already difficult time. This can range from a few $100s to several thousand, depending on your income. The most costly mistake is coming up next. Pay close attention to this one. Mistake 4, not accounting for one-time income events. This is the mistake that costs seniors more money than almost anything else. And it happens because most people don't realize that one-time income events affect their Social Security taxation. Here's what I mean by one-time income events: selling your home and having a capital gain, selling stocks or mutual funds, taking a large withdrawal from your IRA for a major expense, receiving a pension, lump sum distribution, inheriting a traditional IRA and taking distributions, converting a traditional IRA to a Roth IRA. Any of these events can create a huge spike in your income for that year. And when your income spikes, more of your Social Security becomes taxable. But most seniors don't think about this until it's too late. Let me tell you about James and Carol. They were both 70, receiving Social Security and living on a modest pension. They'd been retired for 5 years and never owed taxes because their income was below the threshold. Then they decided to sell their home and downsize. They'd lived in the house for 30 years, and it had appreciated significantly. After the sale, they had a capital gain of $180,000. Now, there are exemptions for capital gains on a primary residence, up to $250,000 for single filers and $500,000 for married couples. So they didn't owe capital gains tax on the home sale itself. But here's what they didn't know. Even though they didn't owe capital gains tax on the house, that $180,000 still counted as income for the purpose of calculating how much of their Social Security was taxable. Their combined income for that year was $180,000 plus their pension plus half their Social Security. This put them way over the threshold where 85% of their Social Security became taxable. James and Carol had never paid taxes on their Social Security before. They didn't have anything withheld. They didn't pay estimated taxes. And they figured since the home sale was exempt from capital gains tax, they were fine. When they filed their taxes the next spring, they owed $11,400 to the IRS. James called me in a panic. He couldn't understand how they could owe so much when they didn't even owe capital gains tax on the house. I had to explain that the home sale still counted as income for Social Security taxation purposes. Who this affects most? Anyone who has a large one-time income event during the year. This includes home sales with capital gains, stock sales, large IRA withdrawals, Roth conversions, or inherited IRA distributions. The simple fix. If you know you're going to have a one-time income spike, talk to a tax professional before the event happens. Calculate how it will affect your taxes for the year. Then either increase your Social Security withholding for that year or make estimated quarterly tax payments to cover what you'll owe. What it costs if you ignore it. This mistake can cost you anywhere from a few $1,000s to tens of thousands, depending on the size of the income event, plus underpayment penalties if you didn't withhold or pay estimated taxes. Now there's one more mistake I need to tell you about, and this one involves state taxes. Mistake 5, ignoring state taxes on Social Security. Most states don't tax Social Security benefits, but some do. And if you live in one of those states and you're not accounting for state taxes, you could be in for a surprise. As of now, states like Colorado, Connecticut, Montana, New Mexico, Rhode Island, Utah, Vermont, and a few others have some form of state tax on Social Security benefits. The rules vary by state. Some have income thresholds, some have exemptions for lower income seniors, and some tax it, just like the federal government does. Here's the problem. Even if you've set up federal withholding from your Social Security check using Form W-4V, that only covers federal taxes. It doesn't cover state taxes. You have to handle state taxes separately. I had a client in Connecticut who got hit with this. She had her federal withholding set up perfectly. She was withholding 12% from her Social Security check, and it was covering her federal tax liability just fine. She filed her federal return every year and either broke even or got a small refund. But she forgot about state taxes. Connecticut taxes, Social Security benefits for higher income residents. My client had a pension in Social Security, which put her over the state's threshold. For 3 years, she didn't pay any state taxes on her Social Security. She assumed her federal withholding covered everything. When she finally realized the mistake, she owed $3,600 to the state of Connecticut in back taxes and penalties. But I'm just scared who this affects most. Anyone living in a state that taxes Social Security benefits. The simple fix? Google, does your state tax Social Security benefits right now? If the answer is yes, find out what the rules are. Then make sure you're either having state taxes withheld from your pension, if you have one, or paying estimated state taxes quarterly. What it costs if you ignore it. You could owe hundreds or thousands in state taxes, plus penalties and interest. And just like the IRS, your state revenue department won't warn you. They'll just send a bill. Now let me tell you what happened to Dorothy after she got that letter, because this is where the story gets better. LW, how Dorothy fixed everything. When Dorothy called me, she was panicked. She had the IRS letter in her hand. She owed $4,200 she didn't have, and she felt like her retirement was falling apart. The first thing I told her was, Dorothy, you're not alone. This happens to thousands of people, and we can fix this. Here's what we did. Step 1. We contacted the IRS immediately and set up a payment plan. The IRS allows payment plans for seniors who can't pay in full. Dorothy paid $200 a month for about 2 years. It wasn't fun, but it was manageable. Step 2. We filled out Form W-4V and had Social Security start withholding 12% from her monthly benefit going forward. Step 3. We reviewed her entire income picture and calculated exactly what she should be withholding to cover federal and state taxes. Step 4. We set a calendar reminder for Dorothy to review her tax situation every January. Within 6 months, Dorothy told me she was sleeping better, she was making her payments on time, her withholding was set up correctly, and she felt in control again. But here's what she said that stuck with me. I just wish someone had told me about this before it became a problem. And that's why I make these videos. Banks don't tell you. Social Security doesn't warn you. The IRS doesn't educate you. They just collect. What you need to do this week. Here's your action plan. Step 1. Calculate your combined income. Add up your Social Security, pension, IRA withdrawals, investment income, and any other income. Use the formula, adjusted gross income, plus tax-exempt interest, plus half of Social Security. Step 2. Compare your combined income to the thresholds. If you're over $34,000 single or $44,000 married, your Social Security is likely taxable. Step 3. If you don't have withholding set up, request Form W-4V from Social Security at ssa.gov or by calling 1-800-772-1213. Step 4. If you're turning 73 soon, losing a spouse, or planning a large withdrawal or sale, recalculate your taxes now and adjust your withholding. Step 5. Check if your state taxes Social Security. If yes, make sure you're covering state taxes too. That's it. 5 simple steps. And if you do these this week, you won't end up with an IRS letter. I'm not a tax attorney, and this isn't personal tax advice, but this is information every Social Security recipient needs to know. If this helped you, share it with another senior. And subscribe for more straight talk about Social Security, Medicare, and retirement. Thanks for watching. Your money is your money. Don't let it slip away because nobody explained the rules. I'll see you in the next video. A 74-year-old woman in Pennsylvania named Dorothy received a letter from the IRS last August. She opened it at her kitchen table, read the first line, and her hands started shaking. The letter said she owed $4,200 in back taxes, plus penalties and interest, all because of one mistake she'd been making with her Social Security check for 3 years straight. Dorothy had no idea she was doing anything wrong. The IRS didn't warn her. Social Security didn't call her. Her bank said nothing. And now she owed thousands of dollars she didn't have saved. Here's what scares me most. Dorothy's mistake is the exact same mistake I see tens of thousands of seniors making right now, and most of them have no idea they're doing it. If you currently receive Social Security benefits, what I'm about to share could save you thousands of dollars and a mountain of stress. But you need to understand something right now. The IRS will not warn you before they send that letter. They will simply calculate what you owe, add penalties, and expect payment. This could cost you thousands. So today, I'm going to walk you through the 5 biggest mistakes seniors make with Social Security and taxes, why these mistakes happen, and most importantly, how to fix them before the IRS comes knocking. Stay with me, because mistake number 4 is costing retirees more money than all the others combined. Let's get into it. The problem nobody talks about. Here's what Dorothy didn't know. Social Security benefits can be taxable, and depending on your total income, up to 85% of your Social Security check can be subject to federal income tax. Now, I know what you're thinking. Wait a minute, I paid into Social Security my whole life. How can they tax me on money I already paid taxes on? I hear this every single day, and I understand the frustration. But here's the reality. The IRS has rules about this, and whether we agree with them or not, we have to follow them. Because if we don't, we end up like Dorothy, with a letter, a big bill, and no easy way out. When you start receiving Social Security, the Social Security Administration doesn't automatically take taxes out of your check. They send you the full amount. It's up to you to either have taxes withheld or pay estimated taxes quarterly. And here's the problem. Most seniors have no idea they need to do this. You see, when you were working, your employer automatically withheld taxes from every paycheck. You didn't have to think about it. But Social Security doesn't work that way unless you specifically request it. The IRS uses something called combined income to determine if your Social Security is taxable. Here's the formula. Your adjusted gross income plus any tax-exempt interest. Plus half of your Social Security benefits equals your combined income. Here are the thresholds. If you're single and your combined income is above $34,000, up to 85% of your Social Security benefits may be taxable. If you're married filing jointly and your combined income is above $44,000, up to 85% of your Social Security benefits may be taxable. These thresholds are very low. If you have even a modest pension or IRA withdrawals, you're probably over these limits. Now let me show you the 5 mistakes that are costing seniors thousands of dollars every single year. Mistake 1, not having taxes withheld from Social Security. This is what happened to Dorothy. She started collecting Social Security at 67. She had a small pension from her years working as a school administrator, about $1,800 a month. Her Social Security was about $2,100 a month. Combined, her income put her well above the $34,000 threshold for single filers. But nobody told her she needed to have taxes withheld from her Social Security check. Here's what she should have done. Filled out Form W-4V. That's the voluntary withholding request form. IT is a simple 1-page form where you tell Social Security to withhold federal income tax from your monthly benefit. You can choose to have 7%, 10%, 12%, or 22% withheld. That's it. 4 simple options. If Dorothy had chosen to withhold even 10% from her Social Security check, she would have been setting aside about $210 per month for taxes. Over 3 years, that's $7,560 set aside, more than enough to cover the $4,200 she ended up owing with money left over. But she didn't know. Nobody told her. And the IRS doesn't send reminder notices. They just send the bill. I see this mistake every single day. Seniors start receiving Social Security, they budget based on that full amount, and they spend it on groceries, medications, utilities, and everyday expenses. Month after month, year after year. And the whole time, they're building up a tax bill they don't even know exists. Then, one day, the IRS runs the numbers. They calculate what you should have been paying all along. They add penalties for underpayment. They add interest. And they send a letter. Who this affects most? Any senior whose combined income puts them over the taxable thresholds. That includes anyone with a pension, IRA withdrawals, investment income, or part-time work income on top of Social Security. The simple fix. Request form W-4V from Social Security. You can do this online at sa.gov, by phone at 1-800-72-1213, or at your local Social Security office. Fill it out, choose your withholding percentage, and mail it back. Social Security will start withholding within a couple of months. What it costs if you ignore it. You build up a tax bill over months or years. When the IRS finally catches up with you, you owe a lump sum you might not have saved, plus penalties, plus interest. For Dorothy, that was $40,200. For some seniors, it's much more. Stay with me, because mistake number 2 catches even financially savvy retirees off guard. Mistake 2, forgetting about required minimum distributions. Here's what happens. A senior retires at 67, starts collecting Social Security, and sets up their tax withholding perfectly. They calculate their combined income, they're withholding the right amount, everything looks good. But then they turn 73. And suddenly, they're required to start taking required minimum distributions from their IRA or 401k. This is new income they weren't accounting for before. And it can push them way over the threshold where more of their Social Security becomes taxable. I worked with a woman named Barbara who ran into this exact problem. She retired at 66, started Social Security, had a small pension, and was withholding 10% from her Social Security check. For 6 years, she filed her taxes with no issues. No surprises, no problems. Then she turned 73 and had to start taking RMDs from her IRA, which had about $420,000 in it. Her first RMD was roughly $16,000. That's $16,000 in new income she had to add to her tax calculation. Barbara didn't adjust her withholding. She figured 10% from Social Security was still good enough. But that extra $16,000 pushed her into a higher tax bracket and made more of her Social Security taxable. When she filed her taxes the next spring, she owed $2,800 to the IRS. She couldn't believe it. She thought she'd been doing everything right. Who this affects most? Any senior with retirement accounts who turns 73 and starts RMDs. Also affects anyone who increases their IRA withdrawals for any reason. Home repairs, medical expenses, helping family, or any other large expense. The simple fix. Mark your 73rd birthday on your calendar as a tax review date. 3 months before you turn 73, sit down and calculate what your RMD will be. Add that to your other income and recalculate your combined income. Then adjust your Social Security withholding or start paying estimated quarterly taxes to cover the difference.